Is Intel, ticker symbol INTC, a good stock to buy now? Welcome to Global Value. In today's video, we're performing a fundamental analysis of Intel using Warren Buffett's investing framework. We'll look at 6 key financial metrics before we figure out 3 different fair values to understand what Intel is worth in today's stock market. Plus, I'll share a special bonus that could be the deciding factor when adding Intel stock to your portfolio. Right now, Intel trades for $30.76 per share. In the last day of trading, its stock was down 0.52%. Since June of 2023, Intel's stock price is down 11.5%. They were beating the market up until about April of 2024, and then things have turned south. In the same time, the S&P 500 is up more than 20%. The last decade has been rough on Intel. Their stock price is down 6.8%, and they dramatically underperformed the market since 2021. When we go back before the global financial crisis, however, Intel's stock price is up 32%. They've compounded at 1.5% each year, and they've also paid dividends over this time. Today, Intel has a 1.62% dividend yield, which we'll look at more later in the video. Right now, Intel is just $1 above its 52-week low. This is down $21 from their 52-week high. And how big is Intel? Today, they have a $131.5 billion market cap. They're one of the largest semiconductor companies in the world, even with their recent woes. Intel is in the portfolio of 4 super investors with David Tepper, Berkshire Hathaway director Chris Davis, and the Canadian Warren Buffett Prem Watsa all having small positions in the company. Starting with our first metric, we want their average returns on capital to be greater than 14%. Over the long run, it's these returns that drive a stock's performance. Intel has had above average returns for most of their history as a company. In 2019, these were at nearly 20.5%, although in every year since then, they've been on a downward slide. In their most recent year, they earned nearly 0% returns on capital in 2023. They've had a really rough time in the last 3 years, and this is a trend we're going to continue to see in their business. When they're averaged out, Intel earns 11.7% returns on capital, which are still surprisingly above average but below the mark we were looking for. It's an X on our first metric. So what does the company do? Intel is a leading digital chip maker focused on the design and manufacturing of microprocessors for the global personal computer and data center markets. Intel pioneered the x86 architecture for microprocessors and was the prime proponent of Moore's Law for advances in semiconductor manufacturing. Intel remains the market share leader in CPUs in both the PC and server end markets. Intel has also been expanding into new adjacencies such as communications infrastructure, automotive, and the Internet of Things. Further, Intel expects to leverage its chip manufacturing capabilities into an outsourced foundry model where it constructs chips for others. Just recently, the company announced an $11 billion joint venture with Apollo to invest in a chip fab in Ireland. Next, we want growth in their sales, earnings, and free cash flows. All of these need to be up, and unfortunately, they're all down. Intel's sales have declined by 23%, their earnings are down by 81%, and their free cash flows, which were positive until 2021, are down and negative today. The company's bottom line hurts as its top line has decreased. It's a business that benefits from operating leverage during good times, and this works in reverse during bad times. Not to mention, the company also increased CapEx over this time. It's an X on metric number 2. In our third metric, we want Intel's earnings per share to have grown. Surprisingly, their earnings per share aren't down as badly as their earnings, yet they've still declined by nearly 75%. This is because the company bought back 5.5% of their shares in the last 5 years alone. These would have been great if they were in a better financial position. Instead, they may have destroyed value for shareholders. Either way, their earnings per share are down, and it's an X on metric number 3. So far, things aren't so hot, but can Intel turn it around in the back half of our analysis? Why don't we find out? Next, we're looking for free cash flow per share growth, and this is the same story. Their free cash flows per share are negative today, and they've been negative in the last 2 fiscal years. Intel was in a decent place until 2021, but that's no longer the case as they're scrambling to play catch-up with Taiwan semiconductor manufacturing. With these cash flows per share negative, it's another X on metric number 4. Before we look at the company's balance sheet, why don't we check in on their dividends? Right now, Intel pays a 1.62% dividend yield, but is it safe? That's what we're trying to figure out here. The company has regularly paid dividends for a long time, and up until 2022, they were actually growing these. However, in the past 2 years, they've cut their dividends by 60%. Even with these dividend cuts, they still don't support them with their cash flows in either of the last 2 years. Again, those both suffer from lower cash from operations and increased capex. That's not what we would want to see as shareholders, and we would ideally want them to cut their dividend payments to focus on their core business. That would be a better capital allocation decision until they can stabilize things. This is an X as we look at their dividends. In metric number 5, we want the sum of their free cash flows to cover their net debt position. That was the case for much of the company's history. They ended 2023 with $24 billion in net debt, and today they've increased this to $29.7 billion worth. At the same time, after consuming cash in their business in the last 2 years, Intel has only brought in $4.57 billion of free cash flow when we add these up. Together, that's not enough to support their debt loads, and Intel needs to generate cash unless they're going to take out more debt or raise equity. If they can get back to their past cash flow position, the company could easily afford these debts, but not today. It's an X on metric number 5. Before we try to figure out what Intel is worth, why don't we look at our bonus? Warren Buffett's teacher and the father of value investing, Ben Graham, wanted to see a current ratio greater than 1.5 times. This is a measure of short-term liquidity for how a company's total current assets can pay their total current liabilities. It's a key safety metric that you wouldn't want Intel to compromise on. Thankfully, today the company has more than a 1.5 times current ratio, and they've maintained this position in each of the last 4 years. This is one silver lining for the business, and it is our first check today coming in on our bonus. Now, how much is Intel possibly worth? The big metric of them all, metric number 6, is also our first valuation. Here we want Intel's average free cash flows divided by their enterprise value to give us a yield greater than 5%. This would match the historical yield from the S&P 500 and gives us a rough starting point for what they're worth. Today, Intel has a $166 billion enterprise value, which helps us look at the company like it's a private business by adding their net debt and their market cap together. They only bring in $1.5 billion of free cash flow in an average year over this time. Because of that, we get less than a 1% cash flow yield for Intel today. They've also consumed cash flows in their last 3 years and in their last 12 months. This means they have a negative 3-year average and a negative current yield. If Intel can get to their historical cash flows, they'd be trading for nearly a 10% yield today. That would be highly attractive, but that's not where they're at. That's not what we wanted to see, and it means it's an X coming in on metric number 6. Unfortunately, Intel is 0 for 6. But surprisingly, the company is still worth something, and that's what we'll see in our next 2 valuations. In our second valuation, we're using a DCF model to estimate Intel's growth into the future. Let's assume their cash flows turn positive and they grow at 5% in each of the next 10 years. We'll then assume that these grow at 4% in the next decade. After that, we'll add in the majority of Intel's value through their tangible book value, which gives an estimate of their net worth. If we're looking for a market-beating 15% rate of return, which is what Warren Buffett wants to see, then using these assumptions, a DCF valuation says Intel's worth around $33 per share. But keep some key points in mind. Throughout its history, Intel has been a long-term compounder. They're up more than 1,000 times from when they went public in the 1970s. But as we can see from their stock chart, semiconductors are a cyclical industry. Intel spiked at their all-time highs back during the dot-com boom. Then as their sales slowed and the tech bubble deflated, their stock price crashed as well. Our third valuation uses estimates for the future and where Intel is traded compared to its past. Right now, this comes in at $32.60 per share. Now, we've covered the numbers that Warren Buffett likes, but it's the qualities of a company that he really loves. Let's learn what these are through Intel through a long and a short thesis. Let's start with a long thesis first. Number 1, Intel is one of the largest semiconductor companies in the world and holds the lion's share of the PC and server processor markets. Number 2, Intel is making some smart moves in its turnaround plans. It's shedding off some non-core businesses, spinning off shares of its attractive automotive business Mobileye, and seeking innovative co-investment partnerships with financial firms, like the joint venture announced with Apollo. Number 3, the AI semiconductor market is booming, and Intel is one of the few merchant firms with a diverse enough portfolio to serve a large portion of the market. But it's not all positives. Let's look at a short thesis too. Number 1, Intel encountered significant manufacturing delays in years past. There's no guarantee it can execute well in its aggressive aspirations to develop 5 process nodes in 4 years. Number 2, even if Intel can regain manufacturing parity with TSMC, AMD now sits as a far more credible chip designer in the x86 space for PC and server CPUs. Number 3, NVIDIA's GPUs have captured most of the artificial intelligence accelerator market. Cloud computing spending may also continue to shift toward these GPUs and away from Intel's products over time. We're even seeing big hyperscalers like AWS create their own chips. Now let's put everything together for Intel. In today's analysis, we learned the company goes 0 for 6 for the fundamental numbers we were looking for. They only check the box on our bonus metric as they support a decent current ratio. Everything else looks rough as the company's sales have declined in the last few years and they're not consuming cash. They're earning virtually no returns today and they're in the midst of a turnaround. Now, the number one question I get asked from viewers is how to find undervalued stocks even faster. That's why I use tools like this one which show Intel's fair value. Today, when we put everything together for the company, this looks like it comes in around $21. Intel could be attractive around their book value, but today that's $10 below their current stock price and half of their street target price. Intel seems overvalued. To find undervalued stocks, sign up for our investing tools and get exclusive bonus coverage of 89 stocks and counting.